Hello, this is Books of the Stock Market. How's everyone doing? As for me, I feel great and it's nice and sunny outside. It might be a bit cold, but if the sun is out, then I have nothing to complain about. Other than the weather, I think I have to change my running route now since it's winter, and my running route usually consists of a mountain path, and you may have seen some pictures of that course at the end of the videos. But since it's winter now, the path is all frozen and muddy, so it is hard to run at a comfortable pace without twisting an ankle or falling. With that out of the way, let's now move on to the reason why everyone is here. Last video, we talked about continuation patterns and triangles. This video will continue to go over different continuation patterns. This video will be going over flags, pennants, wedges, and rectangles, all of which are continuation patterns. I'll first introduce both flags and pennants as they have a lot of similar characteristics. Both represent brief pauses in market movement and they usually come after a straight line move up or down. They both should see a decrease in volume when the flag and pennant is forming. Before the flag and pennant, there should have been an increase in volume, since, as we described before, the previous price action usually takes form of a straight line move up or down. After the flag and pennant, there should also be an increase in volume, so that volume can confirm the breakout. Next, they usually occur at the midpoint of the overall market move. This means that there should be another straight line move similar in length at the breakout point of the flag or pennant. The difference between a triangle and a flag or pennant is that the flag or pennant is usually shorter in length. So the flag or pennant will last only a couple of weeks while a triangle may last months. Finally, a flag or pennant that is formed in a downtrend is usually shorter in length than a flag or pennant formed in an uptrend. With that introduction out of the way, you may be wondering what flags and pennants actually look like. Let's start off with a flag. A flag has a shape of a parallelogram or a slanted rectangle. Therefore, a flag is made up of two parallel lines. The two parallel lines also slope against the current trend. So in an uptrend, the flag would slope downward, while in a downtrend, the flag should slope upwards. Here is an example of a flag. The stock shown is SPY, which is an ETF that tracks the S&P 500. Here we see a straight line move up, and this will be the pole of the flag. I then drew this trend line, and we see that price keeps getting rejected by this line. I copied this line and then pasted it down here, and we see that it does seem to work as a support line. Lines 1 and 2 represent our flag, and we should see price consolidation here. Since price is consolidating, we should see a decrease in volume, as shown here. We see a breakout happen here. What type of volume levels should we see? We should see an increase in volume, which does happen here. Next, let's look at what a pennant looks like. A pennant is basically a small symmetrical triangle. Let's now look at an example. This is QQQ, which is an ETF that mirrors the Nasdaq 100. We see that a pennant is forming. We see that the upper trend line is formed by two lower highs, and we can also see that the lower trend line is formed by two higher lows. Therefore, these two lines would have to converge and take a shape of a triangle. Now, let's look at volume. Here, we see a small decrease in volume, although it is not much. We see this deviation from the norm because the markets during this time was especially sporadic as prices were fluctuating up and down. Therefore, it is important to remember to be flexible with technical analysis and adapt to different situations. Here, we see price break out. And what type of volume levels should we see with price breaking out? We should see a huge increase in volume as shown here. Now, let's talk about what happens when price breaks out of the flag or the pennant. When the breakout happens, we should see an increase in volume. So, in an uptrend, if price breaks out of the upper trend line, we should see volume increase to the upside. Likewise, in a downtrend, price needs to break out of the lower trend line with heavy volume. As for the projection of price, Once the breakout happens, you just need to measure the distance of the preceding move, starting from the original breakout point. The original breakout point is usually the start of the trend where price broke out from a support or resistance level. You then add this distance to the breakout point of the flag or the pennant. The next continuation pattern we will be talking about are wedges. Wedges are two converging trend lines that both slope toward the same direction. They slope against the current trend, so in an uptrend, a wedge that is pointing downwards would exist and would be called a falling wedge. On the other hand, in a downtrend, a rising wedge would most likely be formed. However, with all things in technical analysis, there are exceptions. Sometimes a rising wedge can be formed in an uptrend, likewise a falling wedge can be formed in a downtrend. This usually happens when the top or bottom may be forming. Let's look at an example of a wedge. Here we see gold on the daily time frame. Here we can see two blue converging lines sloping downwards. This makes sense because gold is currently in an uptrend and is consolidating. How do we know it is consolidating and not a change in the trend? We know this because we see that the overall volume levels have drastically decreased for a couple of months. Also, if we look at the wider picture and start from the month of August, we can see that this is technically a bull flag pattern. We see that there was like a huge run-up, and till this day it has been consolidating for a while. So gold might be something everyone should put on their watch list. But remember, you have to wait till there's a break in the trend line at close, because who knows how long this sideways action can last. Let's now talk about rectangles. Rectangles are made of two parallel lines, and price seems to just bounce in between these lines. This almost never indicates a reversal pattern, so if you see a triple top or triple bottom form within a triangle, it does not mean that the trend will reverse. As for volume shouldn't decrease like flags or wedges. This is due to the stock trading within huge price boundaries. For breakouts, it should follow the same rule with all price patterns in that you need to close above or below the lines. Once the breakout has occurred, price would go the height of the rectangle starting from the breakout point. Here we see an example of a rectangle. This is SPY, and we see that price was consolidating between two blue lines from February to June. We see that price gets rejected at around $240 a couple of times. Once it was rejected, we saw that price bounced down to $232 and found support there multiple times. It then bounces to the 240 area, and as you can see, this type of pattern is really easy to trade since you can buy when you hit support and sell when you hit resistance. Furthermore, if price breaks out, you can sell your position immediately and swap sides and ride the spike in the correct direction. The last continuation pattern we'll be talking about is the head and shoulders continuation pattern. They're very similar to rectangles and can be technically classified as a rectangle, so I consider it like a special type of rectangle where in an uptrend there is a trough in the middle of the rectangle, whereas in a downtrend there is a peak in the middle of the rectangle. To illustrate, in an uptrend we see the head represent the trough in the middle of the rectangle. Likewise, we see the head represent the peak in the middle of the rectangle. As in both cases, the trend did not reverse but instead continued the prevailing trend. Let's now look at an example. Here we see QQQ. As you can see, the middle of this downtrend, we saw a rectangle form. However, this rectangle is a special rectangle as we saw a head and a shoulders continuation pattern. For instance, here we see the left shoulder form, the head, and then the right shoulder form. So the price was bouncing in between this rectangle for about 2 to 3 months. It finally broke out here, and price continued to fall for a couple of days. Well, that's it for this video. I hope everyone learned as much as I did reading the book, as that is the whole point of this channel. In this video, we learned about flags, pennants, wedges, and rectangles. Until now, we have mainly looked at technical analysis through price. The next video will look at technical analysis through volume and open interest. So if you don't want to miss out on these topics, please subscribe to the channel. If you enjoyed this video and felt like you learned something new, like this video as it really supports the channel. If you have any questions, leave a comment below and I'll try my best to answer all of them. Well, this is Books of the Stock Market, and I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.